Getting a read on the American economy is difficult at the moment. From certain angles, it looks terrible. The job market, for instance, is at its weakest since probably the early 2010s, if you exclude the pandemic. But from other angles, it looks like it's doing all right. Despite a lot of talk about a recession earlier this year, GDP growth has held up all right. And, according to Polymarket, the odds of a recession have fallen from over 50% a couple of months ago to 10% today. But when you dig into the data, it quickly becomes clear that, while the headline numbers are sort of mixed, this economy looks unequivocally bad for young Americans, especially those just entering the job market. So in this video, we're going to explain why young Americans have it so rough, and whether things might get better anytime soon. Explore which world leaders are winning and which are losing every week with our new podcast, The World Leader Leaderboard. Find it over on the TLDR Podcast's YouTube channel or in your favourite podcast app. So let's get straight into it. As we see it, there are two big reasons that the US economy looks particularly rough for young people at the moment. The first is the job market. In short, for the past year or two, the US has been in a low-firing, low-hiring job market. Businesses aren't really hiring anyone, but they're also not really firing that many people either. You can see this in the Bureau of Labor Statistics data. Job creation has been pretty weak recently, but the overall unemployment rate has stayed relatively steady, at least in part because companies aren't firing as many people as you might expect during a slowdown. Similarly, the BLS's Job Openings and Labour Turnover Survey has recorded consistent declines in hiring, quitting and new job openings since the pandemic, with the hiring rate now at its lowest level since 2013. Unsurprisingly, this low hiring has made workers pretty pessimistic. 20% of job seekers now say that jobs are hard to come by, the highest figure since 2021, while the perceived probability of finding a new job, if one were to lose their current job, stood at 45% in August, the lowest reading since the New York Fed started asking this question in June 2013. So what explains this low hiring, low firing paradigm? Well, the low hiring bit is probably a response to the economic uncertainty induced by Trump's unprecedented tariff regime, while the low firing is plausibly a response to the super tight labour market we saw coming out of the pandemic and into 2023, when there were far more job openings than workers, which in turn allowed workers, and especially low earners, to demand higher wages. This meant businesses had a tough time hiring in 2022 and 2023. There weren't enough workers to go round, and they had to offer higher wages to attract new employees. Apparently scarred by this experience, businesses have since been reluctant to let go of existing employees because they don't want to have to dip back into the job market to replace them. Anyway, this low hiring, low firing environment is fine for anyone who's already got a job, but rubbish for young people entering the job market for the first time. It's why the unemployment rate for 16 to 24-year-olds has risen steadily for the past 2 years or so, and is currently sitting at 10.5%, the highest since 2016 if we exclude the pandemic. Similarly, new entrants into the job market currently account for 13.4% of the overall unemployed population, a 37-year high. New graduates are having a particularly tough time at the moment, and the unemployment rate for recent college grads has now settled higher than the overall unemployment rate, reversing a multi-decade trend. In other words, for basically the first time in history, young grads are now less likely to have a job than the average worker. This might be partly down to the fact that businesses are using AI to replace entry-level grad jobs. A recent paper out of Stanford University, for instance, found that young graduates in AI-exposed occupations suffered a 13% relative decline in employment, while employment for workers in less exposed fields and more experienced workers in the same fields has remained stable or continued to grow. Interestingly, things seem to be particularly tough for young men, with the unemployment rate for young men, both with and without degrees, rising far faster than that for young women. You get the idea. This low hiring, low firing job market has been particularly bad for young workers entering the workforce. This is obviously immediately bad for young Americans, but it will have long-term consequences for both this generation and the wider US economy. Research suggests that people who experience unemployment early in their careers suffer permanently lower earning potential due to lost opportunities to gain experience and develop skills. Anyway, on to the second problem facing Euro-America, the national debt. Despite all of Trump's talk of balancing the budget, in the first 11 months of this fiscal year, the US ran its largest budget deficit ever, excluding the pandemic, and is on track for a budget deficit representing about 6% of GDP in 2025. For context, according to the IMF, this would be the largest budget deficit in the entire developed world, and the Treasury currently expects America's overall debt burden to surpass 200% of GDP by 2050. This combination of chronic deficits and enormous outstanding debt pile has sparked some anxiety in the media, but mostly concerning the possibility of some acute fiscal crisis in the near future. This overlooks arguably the more fundamental issue with the ballooning national debt. It's a burden on future generations, who will have to eventually pay it off. National debts don't necessarily burden future generations. If debt is used sensibly to finance productive investments, then it's a win for everyone. But this doesn't seem to be the case in the US. For starters, it's hard to argue that the national debt is being managed sensibly. Not only are the deficits we're currently seeing unprecedented in historical terms, but they're also giving way to higher borrowing costs, which are, in turn, making it more expensive to service the debt, i.e. to pay off the interest on it. This feels like a pretty terrible deal for young Americans, who will have to pay trillions more in taxes just to meet these interest payments. But nor do these massive deficits seem to be going into productive investments. In fact, the most recent budget-related bit of legislation, Trump's so-called Big Beautiful Bill, mostly used new debt to pay for tax cuts for rich people. Die-hard neoliberals might argue that this is actually good for everyone, because tax cuts will mean more GDP growth, which will eventually trickle down to everyone, young people included. But this isn't a very popular position. All in all, things don't look great for young Americans right now, especially when you consider the oft-overlooked consequences of America's ballooning national debt on intergenerational inequality. With the rise of complex geopolitical situations like these, as well as confusing economics and the growth of AI, things are moving very fast right now. It would be sensible then to begin improving your critical thinking skills so that you can keep sharp and better understand what's going on. And the best way to do this is through Brilliant. Brilliant knows that learning a little every day is one of the most important things you can do, both for personal and professional growth. So